Okay, so hello and welcome to this Hutchings webinar. Today we are discussing how you can increase the market value of your pharmacy in London and the southeast of England. Little bit of housekeeping before we get started. This webinar is being recorded and will be available to watch on demand by the end of this week on our YouTube channel. I will send around a link to everyone that attended tonight with a link to the recording. So if there's anything that you missed and wanted to watch again, then you'll have a chance to do so, or forward it on to someone that you know that is also thinking of selling their pharmacy. There will be a Q&A session towards the end of the webinar. If you have any questions that kind of arise throughout the session, then you can submit these anonymously using the Q&A button at the bottom of this video feed. You can submit your questions at any time, and we'll answer as many as we can tonight at the end of the session. And any that we don't have time for will definitely be followed up with you directly by whoever on our panel is most relevant to do so over the next day or two, definitely by the weekend. Our expert panel tonight are Paul Steet, Associate Director of Hutchings Consultants.
Hi, good evening. Good evening all.
Reena Popat and Hammad Naveed of Bond Solicitors.
Hi, everyone.
Hi.
And Atif Butt, Senior Accountant at Hutchings Accountants.
Hi, everyone.
First of all, just to our panel, thank you so much for doing this for us tonight. And kicking us off is Paul from Hutchings Consultants. Paul, if you're ready, we'll hand over to you.
Okay, that's great. Thank you very much, Sam. Bear with me 1 second, please.
That's great, Paul. I'm going to just turn my video and audio feed off, and I'll be waiting in the wings as you need me.
Okay, lovely. Thanks, Sam. Thank you. So welcome to the webinar this evening, as Sam mentioned. The three presentations this evening will explain the process involved in selling your pharmacy business from valuation through to completion, taking into account the marketing, accountancy, and legal aspects of a sale. We will also cover briefly some of the most common issues that arise, which you should be aware of as a prospective seller. These various issues have the potential to seriously impact the length of your sale and could affect the eventual amount of money you walk away with on completion. Our aim is to highlight these now in order that you may take steps to remedy or limit their impact ahead of any future sale. The knowledge and advice we are sharing with you has the overall theme of seeking to minimise your stress during a sale and maximising the price you eventually walk away with. You can be assured that Hutchings Consultants, Bond Solicitors and Hutchings Accountants have years of knowledge and experience in pharmacy transactions and understand how a pharmacy sale should work. For those of you who've not sold through Hutchings Consultants before, I just wanted to briefly explain that we are the largest independent pharmacy-only agent in the UK. Our typical sales will range from single pharmacies with a turnover around £300,000 up to small groups with around £100 million turnover. We are approved and recommended by the NPA to its members for the selling and buying of pharmacy businesses since 2005, and are currently the only NPA supplier to reach platinum status. We have an excellent reputation in the sector, and we're clear we never take a payment from anyone who's buying a pharmacy we're instructed to sell, nor do we take referral fees from solicitors or finance brokers we make introductions to. Therefore, there is zero risk of a conflict of interest arising during your sale, which could potentially create an issue. Overall, we have a wealth of knowledge and a broad range of experience in selling pharmacy businesses. This enables us to provide you with an insight on current factors affecting the market. Before I explain the process of valuing and selling your pharmacy business, I would like to briefly share with you what our experience of the market has been over the last 12 months, how the market has changed, and run through some key business performance indicators. As some of you may be aware, there's been a significant increase in the number of pharmacies entering the market for sale, most notably in the last 6 months. Many of these new pharmacies have come as a result of various multiples implementing divestment strategies, but we've also seen more independents come to the market as well. In a small marketplace, this is a rapid increase over a relatively short period of time, which has impacted the market across England and the South East in particular. It's reassuring to see that the increase in opportunities has boosted buyer interest in the current market. I'll explain in more detail shortly which groups of buyers have been acquiring, but In respect of corporate disposals, these have generated interest from first-time buyers entering the market, existing owners seeking to grow, through to larger groups wanting to expand strategically. In the first quarter of 2023, we saw a 48% increase in the number of instructions compared to the first quarter of 2022, which demonstrates the level of selling activity we are currently experiencing. As for buyer interest and activity, in the first quarter of 2023, we saw an increase of 202% in the number of new registrations compared to the same period in 2022. Overall, it's been an extremely busy start to the year. So how's the market changed in 2023? Well, at this point of the year, we can see that the large influx of pharmacies has had different effects on the market. As mentioned, the number of opportunities for buyers to acquire has quickly risen, and many of these same buyers will no doubt wish to expand in the future, thereby regenerating the sector for years to come. The corporate disposals initially diverted many buyers away from the mainstream market. However, many of these opportunities have had their issues, which has led to many buyers deciding to look at other pharmacies elsewhere on the market. However, partly due to oversupply, the effects of inflation and some buyers lowering their bids, we have generally started to see some downward pressure on goodwill prices in recent months. As a result of the huge increase in transactions across the market, timescales for a successful sale to complete have been impacted as well. The component parts of the market which are essential to most transactions, such as banks, solicitors, valuers, and NHS local area teams, have seen a sharp increase in their workloads. This has led to some delays as those teams have worked hard to meet the challenge. As a seller, you need to be prepared for your pharmacy sale to take longer to complete, particularly if bank lending or the NHS change of ownership process is involved. Every pharmacy sale has its own unique set of circumstances, and if timescales are important to you, I recommend you contact either myself or one of my colleagues at the earliest opportunity to discuss how and when you are best advised to start your preparations. Before I move on, we're just going to run a quick poll to understand where you might be in your potential sale journey. This information helps assist us in shaping future webinars, and your participation is much appreciated. Sam, can you please start the poll, and we'll give it a few moments just for everybody to enter their thoughts. Thank you.
I've just launched that now, Paul. That should be live with everyone.
Okay.
And yeah, I can see that we've got answers coming in already.
Okay, we just give it a little while just for people to have a chance to respond. Okay, so thank you for that, everyone. Now let's move on and take a look at some of the key performance indicators we've seen over the last 12 months. As a guide, pence in pound figures provide a broad overview of prices that are being paid for each pound of turnover. Please note that the following slides exclude any corporate sales data, as these sales are at a very early stage and haven't completed in any significant numbers yet. However, future webinars will incorporate this data into presentations going forwards. In terms of average goodwill prices achieved, pharmacies in London and the South East generally outperform other parts of England. As you can see here, the average price in the South East, which excludes pharmacies sold within the M25 for the purpose of this data, has increased since 2021 and interestingly is outperforming London in the first quarter of this year, although it is still relatively early in the year to draw any firm conclusions. Generally speaking, there is significant buyer demand for pharmacies in the South East, either due to a desire to relocate to the region from other parts of the country or because a large number of buyers live here already. There are 2 points I wish to stress about this data today. The first is that potential sellers should be aware that these figures are average prices achieved. Every pharmacy sale is individual, and there are sales that will have achieved a price below the average and others that far exceed it. The other important point to mention is that this data is based on completed sales. These deals would have been agreed in the last 12 months prior to the large number of corporate disposals entering the market. As mentioned a short while ago, due to an oversupply in the market, we have seen lower offers being made, creating some downward pressure on goodwill values. This could impact future prices over the coming months as we progress through the year. This next slide shows the average number of offers received per sale. You'll see on average there have been more offers per sale in London recently when compared to the rest of the South East. This is largely due to a high proportion of lower turnover pharmacies sold, creating more opportunities for first-time buyers to bid for. Offers in the rest of the South East peaked last year and have fallen somewhat. However, some of these sales have been sold off market, which would have a knock-on effect on the amount of parties making an offer. This next graph shows the multiple of EBITDA, also known as the adjusted net profit, achieved on completed sales. Both London and South East pharmacies have seen an improvement over the last few years. You might imagine that as London average prices have fallen in the first quarter of this year, that the multiple of EBITDA would have also fallen. But a high proportion of smaller turnover, less profitable pharmacies sold has bucked the trend and actually improved the average figure. An important key performance indicator for both sellers and buyers alike is the gross profit percentage margin the business is trading at. Average gross profit margins in London have historically outperformed other parts of the country for a number of years, but outside of London, margins have remained fairly steady. This reflects the hard work invested by many owners who have recognised the need to focus on this area during these challenging times. With NHS contracts leaning more towards the provision of services and less focused on dispensing reimbursement, as well as a rapid rise in certain drug costs, it'll be interesting to see what effect this will have on margins going forwards. As with the previous slides, this data is based on sales completed, which will include accounts from 2022 and later. Current valuations we're undertaking suggest margins may be falling, but it's too early to suggest this is a common trend just yet. The next few slides provide an overview of which groups of buyers have been the most active over the last 12 months or so across London and the South East. As I mentioned earlier, this data excludes any current corporate sales, and for the purposes of London, looks at the pharmacy sales located within the M25 boundary. This slide shows the breakdown of buyers for the first quarter of 2023 compared to the whole of 2022. Existing pharmacy owners seeking to expand have been most consistently acquiring, followed by first-time buyers, then group owners. Despite the many pressures contractors are under, it's been encouraging to see many still retain the appetite to expand when the right opportunity has arisen. In recent months, we've seen a fairly large influx of investors from outside of pharmacy registering as new buyers for the first time. However, we're yet to see this interest flowing through into offers and subsequent sales agreed. As we saw in London, existing pharmacy owners have also led the way in acquisitions in the rest of the South East, followed by group owners and then first-time buyers. As we look ahead to the remainder of the year, we're all aware we're living through a very turbulent time. One would suggest this isn't likely to settle anytime soon, and the challenges we see today are likely to persist for some time yet. The unsteady geopolitical situation with the war in Ukraine and the longer-lasting effects of COVID and Brexit have created or exacerbated a variety of different pressures. Inflation has pushed up business costs, local and staff shortages have contributed to wage increases, not to mention drug price and supply issues, all of which will ultimately affect your bottom line profitability and potential goodwill value. Recent bank interest rate increases have also added further pressure on costs for both sellers and buyers alike. In respect to supply, we anticipate that as we progress through the year, the market should return to normal as the large influx of corporate disposals is expected to calm down. However, it is anticipated that rising costs could place some downward pressure on goodwill values in the year ahead, as increased operational costs will start to reveal themselves in trading accounts. Most pharmacy deals require bank funding, and their desire to lend is crucial in supporting the market. Banks' appetite to lend to the sector remains firm, however, there is no avoiding the effects of any interest rate rises. Any rises ultimately impact loan repayment costs, which in turn feed into buyers' calculations and decisions when submitting their offers. Banks' detailed scrutinisation of buyers' loan applications is expected to continue at a time when their teams are under a heavy workload. In order to streamline their work and costs, many banks are now unwilling to provide credit approval for loans until such time the prospective buyer has had their offer accepted. This can make it a little more challenging when assessing the financial strength of a buyer at offer submission stage. Despite the many headwinds community pharmacy has faced over recent years, the sales market remains robust and potential sellers should feel encouraged. The recent announcement of £645 million worth of extra funding for the sector is a positive move and suggests we may possibly be at a turning point with the government funding. For those owners operating 100-hour pharmacies, the proposed change in pharmacy regulations, allowing contractors to reduce their opening hours to 72 hours, will have no doubt been well received by many of those affected by staff shortages and increasing costs. Assuming that staff and operational costs will reduce as a result of implementing the changes, those pharmacies able to reduce these costs should see an improvement in their goodwill values. So that concludes the brief overview of the current marketplace across the UK. I'll now move on to explain the steps involved in taking a pharmacy business to market from valuation stage right through to completion. But before doing so, we're just going to run another short poll, as I'm keen to understand what your opinion is on the extra funding announcement. Sam, can you please run the poll now, please? Lovely. Okay, thank you. Thank you, everybody. So before we can start the valuation or marketing of the business, it's important to establish what that business is actually worth and recommend a marketing price. A competent agent needs to understand your business before they can advise you, and will need to gather financial information from you to conduct the valuation. This is an example of the information we typically ask sellers to provide to us. We don't wish to overburden you, but the more information we have at this stage, the more accurate we can be with the valuation. This will reduce the risk of disappointment for you when offers are called in. We review all the information supplied and produce an adjusted EBITDA figure, otherwise known as adjusted net profit. We then calculate the value by adding a multiplier to this figure, and at the same point consider any other factors that can affect the value. Most sellers understandably want to achieve the best price they can when it comes to a sale. Many owners ask us which areas of the business they should focus on to increase its value. For most pharmacies, there are 4 key areas to focus on, as they can impact the saleability and value of the business. Firstly, gross profit percentage margin. As previously mentioned, this is at the forefront of most buyers' minds when looking to buy a pharmacy. As mentioned earlier, the average margin currently is around 33% in the South East, although it is higher in London. A slight increase in margin could potentially add significant value to the business. Take, for example, a pharmacy with a turnover of £750,000 and a gross profit margin of 30%. An increase of just 1% in margin could potentially add around £50,000 to the value by the time a multiplier is added to the net profit, assuming costs remain the same. Many of our clients advise us they're devoting more time to the buying side of the business and spending more time on researching the best prices. Working hard to improve your margin will be time wasted if you allow your business costs to run out of control. If you are planning to sell, it's so important to keep a tight rein on these costs wherever you can. Both the buyer, their accountant and lender will scrutinise your profit and loss account, and higher costs than the norm could raise some red flags. As previously mentioned, the sharp focus on cost should pay dividends when you come to sell. Item numbers. Even though the remuneration contracts are encouraging the provision of more clinical services, these are still hugely important in the marketplace. The vast majority of buyers remain attracted to busy pharmacies with strong increase in item numbers. I appreciate if you are planning to sell, this may not be an area you wish to focus on, but it will increase the sellability of your business when you eventually do come to sell. Finally, it's important to leave some scope for growth in the business for a new owner. Buyers are excited when they see there are opportunities to grow a business further, and that in turn can help generate interest in your business from the market and improve its saleability. Ironically, buyers are generally less attracted to pharmacies where the current owners have maximised every possible revenue stream. However, it's important to note that in most circumstances, it can be hard to quantify exactly what the value of any potential is. As a result, the market is pretty cautious when it comes to paying for potential, and lenders are unlikely to consider this to any degree, as they attach more importance to proven past performance. The way to view potential in most cases is use it to generate buyer interest and competition, which in turn should help achieve good offers from the market. So coming back to what is next in the process, we have the confidential meeting. This is an opportunity for the consultant to meet you and spend some time understanding your objectives and discussing any concerns you may have. The meeting normally takes place at the premises once the staff have left the day. This allows us an opportunity to view the premises without unduly alerting staff. Alternatively, if this isn't possible for any reason, we can conduct a mystery shop exercise, then meet you off-site at a suitable venue. During the meeting, we discuss and agree the marketing strategy, and it's another opportunity to answer any queries you may have. The next step in the process is preparing the sales literature. A sales brochure is designed to be eye-catching to potential buyers and covers the most salient points of the business, demonstrating profitability and potential. The objective is also to provide sufficient information to buyers at an early stage in order to reduce the volume of questions they may ask. Marketing only commences once you've reviewed and signed off the final document and are happy to move forwards. Unless otherwise specified, a confidential listing is usually added to our website, as this generates buyer inquiries, but we take care to avoid disclosing the exact location of the pharmacy for sale. We also prepare a separate financials pack, which includes copies of the accounts, FP34s, VAT returns, OTC figures, and a copy of the lease if applicable. Before moving on, I want to talk a little bit about the different sales strategies we use to generate buyer interest. As I mentioned, we always discuss and agree with our client the most suitable strategy to use prior to the start of marketing. The most common strategy we use is a full marketing approach, but occasionally we will recommend to clients a more discreet off-market approach is taken. Whichever approach we take, only potential buyers who have registered with us and signed our non-disclosure agreement are contacted. With a full marketing approach, an initial shortlist of buyers is created from our database of several thousand registered buyers. When researching these buyers, the consultants will look at who is active in the marketplace, viewing or making offers, as well as who we believe has the available funds to purchase. The consultants will also discuss the sale with other members of the team to seek their buyer recommendations. Potential buyers then receive the memorandum of sale, followed by the financials pack if they're interested. The buyers are followed up and viewings generated as a result. We keep the marketing under constant review, and the buyers list can be quickly expanded if necessary. The average period of marketing where viewings are taking place is usually around 6 to 8 weeks. As each pharmacy sale is different, the marketing period can sometimes be shorter or longer than this, depending on the circumstances. When it comes to buyers making an offer, Hutchings uses a structured offer process that has been tried and tested over many years. Occasionally, we may recommend to a seller they consider an individual offer, but in most cases, when we feel it's appropriate to set an offer deadline and call in offers, we will discuss and agree this with our client before setting a date. We use a formal offer template letter to avoid any misunderstandings. This is particularly important with company share sales, as they are usually more complicated than asset sales. As part of the process, we request proof of funding and work to secure a deposit from the buyer if their offer is accepted. This is usually no less than £20,000. Following the initial round of offers, we provide some general feedback to buyers before calling in the best and final offers. This allows interested parties to fine-tune their bids and helps increase the competition between them. The competition generated allows us to negotiate the best price and terms possible. Once an offer is accepted, we then move into the legal stage. I won't go into too much depth about this, as Reena and Hammad will cover this area in more detail for you shortly. But we arrange for the buyer's deposit to be paid across to your solicitor, who will then hold the monies in their client account. The deposit monies are held in accordance with a legally prepared deposit and exclusivity agreement, which both the buyer and seller are asked to sign. In exchange for paying a deposit, the buyer is granted a period of exclusivity whereby other potential buyers are excluded from making an offer. We then issue the heads of terms to all parties involved, including the professional advisors confirming the sale. Our role as an agent then changes from one of marketing to that of sales progression, as we consult with all parties during the sale to ensure the sale is progressing forwards. Once an offer is accepted, an average timescale to reach completion is around 6 to 9 months. However, there are many factors that could slow this down, such as bank delays, the NHS change of ownership process, and lease issues, to name but a few. As I come towards the end of my presentation, I wanted to briefly highlight two of the most common issues we see, either prior to or during the marketing phase of the sale. These issues can adversely affect the sale and even the final purchase price, which you as a seller obviously want to avoid if possible. The first common issue is around short leases. A lease is generally referred to as short in the pharmacy sector when it has less than 10 years remaining on the term unexpired. As most buyers require bank funding, they'll be obliged to accept the lending terms offered by the lender. This can potentially become an issue for a buyer and ultimately a seller when the remaining term is less than 10 years, as the bank will usually match the term of the loan to the remaining term of the lease. It's becoming more common now for lenders to specify there must be 15 years remaining on the term of the lease at the outset of the business loan. A short lease can therefore mean the buyer has less time to repay the loan, significantly increasing the monthly loan repayments. The knock-on effect can be that the buyer has to reduce the amount of their offer, or in worst case scenario, curtail their interest due to the deal becoming unaffordable. I strongly recommend if you are a leaseholder that you take the time to check your lease to see if this could potentially affect you. If you believe it may do, I recommend you take advice and consult with ourselves and or a pharmacy sale experienced solicitor such as Carter Bond before approaching your landlord to extend or renew your current lease. I can't emphasise this point enough. It's vital you employ a solicitor with pharmacy sale knowledge to review any new or revised lease before signing. If you don't seek that advice and sign a lease which isn't fit for purpose, you possibly risk seriously affecting both the saleability and the value of your business. The second common issue we come across in pharmacy sales is FP34s in an incorrect trading name. In most cases, it tends to arise where a contractor has changed from trading as a sole trader to a limited company. It's commonly overlooked or not considered as a high priority at the time, and therefore doesn't usually present as a potential issue until much later on when a sale is considered. If selling a limited company and the FP34s are still in the sole trader's name, it's essential that they are changed over as soon as possible, as they could potentially prevent your sale completing. If selling as an asset sale, it isn't necessarily an issue, as the buyer will need to apply for a change of ownership and possibly fitness to practice as well through the NHS process. In my experience, changing the FP34s can either be an easy quick fix or it can lead to significant delays. If it could be proved that the local area team was notified of the change in trading status of the contractor, it should hopefully be just a quick clerical change. However, I have had instances where the sellers have had to apply for fitness to practice and change of ownership for the change in FP34s to be actioned. It usually takes months to complete the process through PCSE and can add undue stress and delay if engaged in a sale at the time. Again, I strongly recommend that if you believe this might affect you, that you take steps as early as possible to rectify the situation and avoid the unnecessary extra stress. When considering selling, it's important to appoint an agent who can provide guidance, support, and is prepared to work hard to achieve the best outcome for you. The team at Hutchings Consultants and our sister company, Hutchings Accountants, strongly believe that we have the necessary expertise, knowledge, and skills to manage your sale and achieve the best price the market will pay for your business. At Hutchings, we have a close-knit team who have over 130 years combined knowledge and experience selling pharmacies. We take pride in the service we provide to our clients and work hard to achieve the best outcome for them. Our experience ensures we can oversee your sale right from the start through to completion. Although we regularly travel around the UK, our team is based in one central office, which allows us to quickly share intelligence on buyers and the current market. We collaborate closely with our colleagues at Hutchings Accountants. If an accountancy-related issue arises during the sale, we can quickly call upon their specialist accounting expertise for advice. So many times, their valuable assistance has helped keep a sale on track, which otherwise might have come unstuck. We have thousands of potential buyers registered from across the UK on our database. They range from eager first-time buyers through to the multiples who we have strong contacts with. This allows us to attract potential buyers for a pharmacy quickly. Finally, we have a straightforward no sale, no fee agreement. There are no upfront marketing costs at all, and we only receive our commission once your sale is completed. We only act for our client, the seller, during the sale. We're clear we do not act for the buyer or take a fee from them. This is important as you can be assured when selling through Hutchings, all the funds the buyer has available are going to you and none are reserved for the agent. So that concludes my presentation for this evening. If you'd like to discuss a potential sale, please do not hesitate to contact me or my colleagues. We can offer you a free verbal valuation, free tax review. We can also arrange a confidential meeting with either myself or one of my fellow consultants at your pharmacy. Thank you for listening. I hope you found the presentation helpful. I'll now hand you over to Reena, Popat and Hammad Naveed of Bond Solicitors, who will explain more about what's involved in the legal process of a pharmacy sale.
Brilliant. Thank you very much, Paul. That was really interesting, and interesting to see what the market is doing as well compared to last year. So thank you very much for that. Welcome to everybody. Thank you for joining us and taking some time out this evening. We are going to be talking about selling a pharmacy, so all the legal jargon and aspects of it. Now, we're going to focus more on the sales side because we've got sellers in the room, but we're also going to touch on buyers as well, because it's important for a seller to understand the mindset of a buyer as well and what they're looking out for. So without ado, let me just introduce myself. My name is Reena Popat. I'm the managing partner of Bond Solicitors. I've been buying and selling pharmacies for over 15 years, so a long time. I've seen lots and lots of quirkiness. Some of it we will discuss and go through during the presentation as well. And I'm also joined by my colleague, Hammad Naveed, who is a senior associate who works with me. Hammad, if you want to say hello as well.
Hi, I'm Hammad. I've been working in the pharmacy sector for about 8 years. My day-to-day involves transactional work, which is sales and purchases. And then within that, 90% of what I do is pharmacy transactions. Definitely my favorite part of my role.
Thanks, Hammad. Just a little bit about the firm as well. So if you've not heard of us, we are a Legal 500 firm. What that means is we're one of the top 500 law firms to carry out and advise on healthcare work, specifically pharmacy transactional work. We complete roughly around about 60 transactions a year. What I mean by that is buying and selling, probably a bit more actually, given that we've had a spike this year already. And we are the only law firm to be recommended as a business partner of the National Pharmacy Association, which we are immensely proud of as well. So without further ado, let's move on to the slides and let's talk about pharmacy sales. Now, when you're selling a pharmacy, there's different ways of selling. You can sell the assets or you can sell the shares. So let's have a think about what the advantages and disadvantages are of each very, very briefly and very quickly as well. So with an asset sale, this is the buyer cherry picking what they want from your business. So the buyer saying, thank you, seller. All I want is the NHS contract. I want the employees. I want the goodwill, and I want the lease assignment or a new lease. And that's it. And everything else, seller, is with you. So especially if you operate in a limited company, they will cherry pick what they want from there and leave the rest with you. The advantage of that from a seller's perspective is that the due diligence is limited. So the questions that they ask via the solicitors is going to be a lot less than if it was a share sale. Also, from the buyer's perspective, it's less risk as well. So usually buyers prefer that option. From a share sale, the disadvantages, or the advantages, sorry, should I say, from the seller's perspective is that it's a clean break for a seller. Once you've sold the shares in the company, you've sold everything, that's it. You can go off in the sunset. Not quite, but sort of, and we'll talk about that. There's also no change of ownership application for the buyer. So from a seller's perspective, it's quite quick as well. There's also no 2P process as well, which can be dreaded. And sometimes buyers and sellers don't quite understand that process. But with a share sale, there is no 2P process as well. And also, if the lease is in the company name, then you actually don't need to contact the landlord to get any sort of consent or any assignment as well, which is quite quick in the process. So the disadvantages with an asset sale obviously is that the buyer has to apply for a change of ownership, and sometimes a fitness to practice as well. That can take quite long. Paul touched upon it briefly. It could take 3 months for the change of ownership application, depending on where the NHS are with their backlog because of COVID as well. And then, of course, once the buyer's got this in, they then have to serve a notice of commencement, which is another 30 days. So all in all, you're looking at around about 4 months or so at the absolute minimum. There's also the 2P consultations, which both the buyer and the seller are legally obliged to do as well. And also the disadvantage sometimes is that the sellers have to contact their landlord to say, look, we're selling, we may need your consent, or the lease is expired and we need to agree a new lease, which can take some time as well. Sometimes we find that sellers don't always have the best relationship with landlords as well, or the landlords just aren't interested and take their time in coming back. So that can delay the process as well. And also, if you operate as a limited company, once the buyers cherry-picked all the assets, the seller's left with a shell company with all the liabilities. So the seller then sometimes has to spend a bit more time and effort than just to liquidate the company or dissolve the company. Easy enough to do, but it's just another process that the seller has to do. When it's a share sale, some of the disadvantages is the stock payment. So the stock payment is usually a net asset payment. So it's part of what we call the completion accounts. So post-completion, there's some completion accounts prepared, and you have to wait until these accounts are prepared and agreed until the seller then receives payment for the stock. So the seller could be waiting 3 months, 6 months as well. And also the main disadvantage is the due diligence, which is quite extensive. And this is purely because the buyer is buying everything, lock, stock and barrel. They're going to be taking on all the assets and all the liabilities if they're buying the shares in the company. So the inquiries are going to reflect that as well. And also there will be tax provisions, but of course we'd work with accountants with that as well, but that will all be covered off in the agreement. So they're the main advantages and disadvantages for an asset sale and a share sale.
So the first part of a transaction right after the Hutchings deposit agreement's been signed is the change of ownership application if it's an asset sale. That aspect sometimes takes between 3 to 4 months. More recently, with all the Lloyd's pharmacy sale transactions happening, it can take around 6 months. That's just because the PCSC is overloaded with applications. So it's important for the seller to understand the buyer's side of this, because it essentially is the biggest driver of timescales. The buyer has to submit their change of ownership application. That's something the seller has to sign. There is a fitness to practice if it's a first-time buyer, and that can also take time to approve. Once the application's been approved by the NHS within 3 to 5 months, let's say, there's a 30-day appeal period, which is where all the pharmacies in the area get to decide whether they would like to oppose that application or not. In our experience, about 99.99% of applications do not get appealed. If they do get appealed or opposed, then the NHS usually quashes it because it's often a frivolous opposition. At the end of the appeal period, there's a 30-day notice of commencement where the buyer would inform the NHS that, I need to take over the business on the 1st of the following month. And the seller would want to make sure that before that notice of commencement's gone through, either we've exchanged contracts or there's a side letter that's signed to say that if we're exchanging and completing simultaneously on the last day, then if the NHS contract gets transferred before then all the NHS income that the buyer gets before completion stays with the seller, because obviously money has not been paid and keys have not been handed over. It's much simpler on a share sale because there is no change of ownership application, as Reena's mentioned. So really all that needs to be done is after completion, within about 28 or 30 days, the parties just have to inform the NHS that the superintendent has resigned and the directors have changed, and that the buyer has appointed a new superintendent. Now, this is important for a seller to make sure that your name's still not associated with the pharmacy from a liability perspective after completion. So although the buyer is meant to submit those notifications, the seller can ensure that there's an obligation in the agreement to make sure that the buyer actually has to do that action. As the change of ownership application is being completed, the buyer's solicitors are going to raise due diligence inquiries. So as Reena mentioned, a share purchase will have a lengthier due diligence exercise. An asset purchase might be a bit more limited. What we see is definitely the due diligence aspect is the most cumbersome part of a transaction for a seller. There are a lot of questions to answer. We try to help as much as we can by setting up a data room to make that process more organized. You just have to dump the documents in, we'll organize them for you, and then we'll walk you through the questionnaire wherever you need help. As soon as the due diligence aspect is well in progress or near to completion, the buyer side usually prepares a sale and purchase agreement. Reena's going to touch on the different aspects of those agreements, but on the side of that, the buyer will also be dealing with their lending. Now, again, the buyer's lending is not necessarily a seller concern, but it's important to understand because it can have an impact on timescales. If the buyer hasn't booked their valuation in early, then that will lead to a delay on their loan offer being approved. That can then have an impact on the timescales. The buyer's lender may have different requirements. So for example, if it's a 7-year lease remaining, then they might want a lease extension up to 15 years, as Paul mentioned. The sellers may have loans outstanding on their business, either it's secured against the property or the company. So we can help you with the redemption of that loan. And usually what will happen is that the funds received from the buyer will partly go towards redeeming that loan. There's also the property element. So if the seller is a landlord as well, then we will help prepare the draft lease to the buyer. The commercial terms usually get agreed in advance, and Reena will touch on what those are. If there is an existing lease for the right amount of time, then it's just a case of transferring that lease over to the buyer where there's a third-party landlord. There's also some ancillary documents we'll touch upon later. But as these aspects tie together, the buyer is then able to draw down, which obviously gets the parties closer to completion. And then obviously, as Reena said, sellers get to ride off into the sunset.
Thanks, Hammad. And that just goes to show that all three processes work simultaneously together. It's not that the lease or the property bit is left and we deal with the due diligence or we deal with the agreements. They all happen simultaneously as well. We are very much led by the buyer side and how quickly they have got their funding in place. But from a seller's perspective as well, these are some of the key points that come up as well, which sellers should be aware of. On the property side, and we keep mentioning property because we find that this is sometimes a stumbling block for whatever reason. I mean, I'll give you a quick story. We had one sale and we were acting for the sellers and we needed landlord's consent. So we approached the landlord and said, we're selling, can we have your consent and what are your requirements? And the landlord came back and said, yeah, sure, we'll give you the consent. Our fees are going to be £12,000. And we kind of fell off our chair and said, you've put an extra zero in your quote. And they said, no, it's £12,000. But sometimes property does take a little while. So it's a good idea just to be aware of this as to if the buyer is, especially if the buyer is taking a new lease, if the lease is expired, or if the seller, if you're actually the owner of the freehold and going to be granting a new lease to the buyer as well, then what you should be aware of. So from a buyer's perspective, they will look at terms, or their solicitors will look at terms such as the rent deposit. Is there going to be a rent deposit? How much is it? When is it going to be paid? And also from a seller's perspective, if you've already paid a rent deposit to your landlord, then we've got to make sure that that comes back to you as well without the landlord kind of dipping into it as well. Secondly, the rent review as well. Is there a rent review coming up? Is the buyer going to have the brunt of that as well? What's that going to be? Is there, has a rent review, or what's a rent review supposed to have taken place but it hasn't taken place, in which case we can help you with that and try and manage that with the landlord. Service charge provisions, repairing, maintenance are always a tricky one and up for negotiation as well. Guarantee provisions, this is a common one that we're seeing more and more of lately, and this is where the landlord says, fine, we will assign the lease or we will grant a new lease, but we want the buyer to guarantee and stand behind the tenant, especially if the tenant is a company. And so that sometimes delays because there's some negotiation. Often it's either a rent deposit or a guarantee provision, but we're actually seeing a bit of both now, where the landlords kind of want to have their cake and eat it. So they're saying, we want a guarantor, but we also want 3 months rent deposit as well. So it's a bit of a mixture. And also these lender protection provisions. So we might agree a fancy lease with our landlord, or if you're the landlord, we'll agree the lease with the buyer's solicitor. But if the buyer is obtaining funding, their lender might actually request to see a copy of the lease, and or they might request some protection provisions in there for them, i.e. they're called step-in rights. So before you go ahead and agree a new lease with a landlord, it's a good idea just to see whether the buyer is going to be obtaining funding, or whether we need to add some of these protection provisions in there as well. Otherwise, all it means is that we have to approach the landlord afterwards and do a deed of variation to vary the lease, which can be done. It just takes a bit of time to do. Once sellers have sold, the idea is that you will go into the sunset, or whatever you're going to do. You've booked your holiday. However, sellers do need to be aware of some of these provisions, that there will be restrictive covenants in the agreement. So that means that you won't necessarily be allowed or permitted to set up another pharmacy within a certain radius. You won't be able to approach the staff or the customers' patients as well. So be aware of that. There's also something in there about warranties and indemnities. And these are basically assurances, because the buyer's buying from the seller and paying good money for it. And the buyer's going to say, that's all great, but we want the sellers to confirm and give us assurance that all the information that they've given to us is true. And if anything comes out of the woodworks after completion, then they're going to knock on your door. So we will negotiate that time frame and that period with them. Usually it's anything between 12 months to about 2 years or so. And that means that at any time after completion for a period of 12 months or 2 years, whatever's negotiated, the buyer can actually bring a claim against you. Obviously, there's lots of hurdles that the buyer has to go through before doing that, but there is that period that the seller should, as a seller, you should just be aware of as well. Now, if you're selling the shares in the company, there will be the completion accounts. So that is a set of accounts prepared after completion, and Atif will talk about that as well. But this deals with the apportionment, so what belongs to the seller and what belongs to the buyer. These are prepared usually 3 to 6 months after completion, so quite a while after completion, and then they have to be agreed as well. So just bear that in mind as well. And then that ties in with the stock payment as well, because once the completion account's agreed, that's when usually the buyer pays the stock as well, unless until we can agree something else with the buyer solicitor where they pay a lump sum for stock payment at the beginning as part of the purchase price. Then the stock take happens, and then we do an adjustment. So there are different ways of doing this, but as a seller, it's just something to be aware of, that these are some of the key negotiation points as well.
So Reena touched upon the warranties and the potential for a buyer making a claim. The best way that a seller can protect themselves against that is to just provide as much information as possible to the buyer to make sure that after completion, the buyer doesn't come back and say, well, hey, I wasn't told this, or I didn't know this, or you didn't show me this, because if it's all in the data room, then the buyer would have the opportunity to take a look at it. There's another point where during the marketing stage, it's important to get all the relevant documents organized and in order. So your accounts documents should be in one place. You should have your FP34s collated, bank statements, which might be needed for a share sale because the buyer would need to know the inflows and the outflows and what the working capital position is. The buyer solicitors will be asking questions about staff contracts and staff details, wages, notice period, things of that nature. So it's important to have all your documents in place. And obviously that can go into the data room before a sale is even started, so that the buyer and the seller are ready to go with regards to due diligence. Buyer's side often asks for compliance certificates. So that's going to be your ICO registration certificate, your GPHC registration certificate. If there's waste exemption certificates, those would need to be seen. Insurance documents also need to be provided, primarily when it's a company sale, because again, the buyer is stepping into the seller's shoes as owner of the company. So if there's pharma cover, if it's employee liability insurance, shop insurance, all that needs to be available and renewed to make sure that the buyer is able to seamlessly take over. Again, the easier the process is made for the buyer, the less chance of the buyer coming after completion saying that this wasn't right or that wasn't right. The due diligence questionnaires are fairly standard form in the pharmacy industry. Buyers often ask some additional questions. So for example, if you've got a Saturday locum that comes in every couple of weeks, the buyer would want to know what those hours are, because the buyer would want to see where they fit in within your current staffing structure.
And talking about due diligence, the buyers will ask a lot of questions about the property as well. One of the things they will ask us to complete is what you call the CPSEs, the standard property inquiries, commercial property inquiries. Now, as much as they are standard, they do require the seller for providing a lot more information than what is just standard. So what's not listed on here, this lists some of the inquiries, but what's not listed and what is really important is making sure that you've got your EPC, you've got your fire risk assessment, and you've got your asbestos survey. What we tend to find is that the buyers will say, forego this. They'll say, actually, we don't really need this. We'll deal with this post-completion. It's not an issue for us. But if they're obtaining funding, then 9 times out of 10, their lender will want to see this and they won't lend otherwise. And that's because their lender is usually going to be taking security over the lease and over the property. So they will want to see this. And what we find, it's usually like a big scramble at the end to try and get this into place. So it's a good idea to just think about, have you got your insurances in place? Can you readily provide that and obtain that? Is the EPC all up to date? The asbestos survey, is it all clean? Were there any recommendations on there? Same with the fire risk assessment as well. So it's a good idea to just think about that. Also, I should just touch on the planning documents as well. Sometimes where there's been some changes as well to the premises, whether that's required planning permission or whether that's required landlord's consent, do you have that as well? So making sure that your house is in order, especially on the property side.
So the disclosure letter comes as part of the sale and purchase agreement, where there's a number of warranties in the sale and purchase agreement, like there's never been any employment issues or there's never been any litigation. Now, a lot of sellers, rightfully so, feel like they're selling very clean pharmacy. There's no issues to disclose or worry about. It may be that, sometime in the past there was some dispensing errors and the patient may have tried to make a claim. It's important here to disclose that information to the buyer against those warranties. And again, it's just another way of making sure that the buyer can't come after completion to say, hey, I wasn't told about this, especially if that dispensing error turns into an actual claim. There's general disclosures made, so we would prepare that letter to say that anything that's publicly available, so anything on Companies House or the land registry, the GPHC register, the NHS pharmacy list, any searches the buyer's carried out, those would be generally disclosed, things that the buyer should be aware of because it's publicly available. Specific disclosures dig into each specific warranty. So we'd walk you through the warranties, make sure that that's clear to you what you're agreeing to, and then invite any disclosures. A lot of it will feel like it's a repetition of the due diligence exercise, but again, it's just an extra opportunity to protect yourself. What we always advise is that sellers should be as transparent as possible, be as clear, accurate, and just provide as much full disclosure on any documents, because the more you give, the less chance of a claim and litigation, or even just a fuss from the buyer after completion. So we've talked about 2P, and that's essentially a regulation that was passed in 2006, which ensures that employees who are transferred to a new business owner are not made worse off because of that sale. So from a seller's perspective, what you need to ensure is to let your staff know that there is a sale happening and that their employment is going to be protected. A lot of times we get asked by sellers, when is the best time to tell my staff that I'm selling? So we've had some sellers that have told their staff before the sales even started. In fact, in those transactions, the staff is usually helping the seller with the due diligence, so that makes their life much easier. We've got some sellers that tell their staff at the point of exchange of contracts, or if exchange and completion is happening simultaneously, then it would be 4 to 6 weeks before completion. We have some sellers that prefer to tell the staff right before completion, so a few days before completion, or even sometimes on the completion day. Now, the minimum requirement is for the staff to be informed before completion that there will be a transfer and that their employment terms will be protected. Some sellers prefer to tell staff on the last day just because they might be afraid of staff turnover before completion. The buyer could then have concerns about that, and that could delay a sale. So when you tell your staff is ultimately dependent on you, your relationship with your staff, how long you've been running the business. A lot of sellers who've been doing this for 30, 40 years feel morally obliged to tell their staff earlier on in the transaction just because they don't want them to be alarmed that suddenly a new buyer is taking over. So it's something that we can definitely advise you as and when the transaction progresses to make sure that the 2P transfer happens at the best time for you. There's a number of ancillary documents that get prepared as part of the transaction. There's obviously the sales agreement, the lease, the disclosure letter, but there's also an NDA, non-disclosure agreement, that has to be signed off at the start. If you're giving the buyer a lot of information, your employment contracts, insurance details, you need to ensure that the buyer keeps that information confidential. If you're selling shares in your company, then you would need a board meeting and board minutes to document that. If you're selling your shares, then you have stock transfer forms that deal with that transfer. And obviously, when you're resigning as director from your company, then there's a resignation letter to deal with that. So there's different ancillary documents that deal with different aspects of the sale.
And also, if you are selling the shares in the company, you'll need to transfer over the bank account as well as it is. So it's a good idea to get in touch with the bank to see what the requirements are, because each bank is very different. Some allow you to do it online, some you have to go in and paper sign with the buyer as well. And this takes a long time sometimes to hand over the bank account to the buyer. So just something to think about as well. And post-completion, there are a few things that need to be done. So we've just listed them here as well. So whether it's a share sale or an asset sale, there will be a lease surrender or a transfer. There'll be a pharmacy handover as well. When it's a share sale, as I mentioned, there'll be a bank mandate, resignation of directors, a change of superintendent sometimes, possibly as well. And then there'll be completion accounts, which your accountant will advise you on as well. On an asset sale, there will be the stock payment, which is paid usually a few days after completion. And then there will be closing supplier accounts as well, which you'll have to do. And there will be an apportionment schedule as well, which again is done a few days after completion. So a few things to just think about once you've sold as well and once completion has taken place. So we're just going to wrap up, and just a few reasons as to why you should use us. As we mentioned, we are recommended partner of the National Pharmacy Association with fees, and we get asked this all the time. I can assure you that they are fixed fees, and we're very, very transparent on our fees as well. Between me and Hammad here, we have over 20 years experience, but we have a team of lawyers that work on pharmacy transactions alone, and we act for both buyers and sellers as well. I'm also pleased to say that we have over 380 five-star Google reviews. And even though we act for sellers, we still see this as a long-term relationship. It's not just the case that you've sold and that's it. In fact, we still send some of our sellers birthday cards as well and keep in touch with them as well. We have a client service pledge, which is a charter to you, almost like a guarantee as to what you can expect from us as your lawyers as well, in terms of availability, accessibility, and all matters are partner-led as well. So you'll have access to partners who are leading each transaction as well. And to get in touch with us, here are our contact details. You can contact either Hammad or myself. You can also visit the website. We've got ample information, documents, ebooks and things as well, which you can download. Please make use of that because it's all free and it will just help you with the process as well. So thank you very much for your time. And Atif will now be talking about the accounting side as well, which is going to be very interesting. So thank you.
Hi, everyone.
I'm just going to jump on quickly, Atif.
Yeah.
Thank you, Reena and Hammad. Anyone that's scribbling to try and get this information down, the contact details for Carter Bond, I will be sending out everyone's contact details from tonight's webinar. It will be when I send the YouTube video round. So it'll be this week and you'll have everyone's contact details so you can get in touch with them directly there. Sorry, Atif, I'll hand over to you.
That's great. Hi, everyone. My name's Atif Butt, and I'm the Senior Accountant at Hutchings Accountants, where we've been specialising in pharmacy sales across the UK for over 30 years. Today, we're talking about how to maximise the sale price of your pharmacy in London and the South East. We'll look at the main steps of a pharmacy sale, some of the issues we see coming up along the way, and how you can best be prepared for them. We've heard some excellent points from Paul, Reena and Hammad on coming to market and the legal aspects of a sale, and now I'll be focusing on accounts and tax matters so you can get a comprehensive idea of what you need to be thinking about and when. We'll be covering preparing for sale, pre-sale issues, due diligence, the legal process, completion, the completion accounts, and what happens after completion. Let's start by talking about the first step, preparing for sale and understanding your tax position. If you're thinking of selling your business in the future, it's never too early to start getting ready, even if you don't plan to sell for many years. Being properly prepared makes a huge difference, not only in the price you get, but also in how much you're left with to enjoy your retirement after paying the taxman. This has never been as important as it is now, with a number of risks and uncertainties facing the pharmacy sector and beyond. Recent events such as the COVID pandemic, Brexit, and the war in Ukraine have changed our lives in a way that would have been unimaginable a few years ago and contributed to rising costs in a number of areas. With inflation and interest rates still increasing, the economy is facing an unprecedented challenge, and we're likely to see changes in tax rates and reliefs coming in the near future. The recent budget confirmed changes to the capital gains tax annual exemption, which is being reduced from £12,300 to £6,000 from April 2023, and then to £3,000 in April 2024. Capital gains tax is an obvious target for change as it's currently charged at lower rates than income tax. The government made significant changes to entrepreneurs' relief a few years ago, which I'll talk about in more detail later, and it's possible we might see further changes to come, or even the relief being abolished completely. Paul's talked about the current state of the market and how it's been affected by current events, but as we've seen, there's a number of factors that can change things significantly over the coming years when it comes to sector and market conditions. Now, of course, it's impossible for us to accurately predict what's going to happen now and in the future, but the best way to manage these risks is to be as prepared as possible. Once you've decided you want to sell your pharmacy, be sure to get specialist advice that takes your individual circumstances into account. This will help you work out the best strategy for the eventual sale, having considered the accounting, legal, and marketing perspectives. At Hutchings Accountants, we start by reviewing your accounts and tax position to recommend the most tax-efficient way to structure your sale and extract the profits. Getting this right can have huge implications that can make a difference of hundreds of thousands of pounds to your tax bill. It's really important to look at this as early as possible, as getting the best tax treatment sometimes involves making changes to the business years in advance of an eventual sale. If your pharmacy is trading through a limited company, the sale can be structured as a share sale or an asset sale, as Reena and Hammad explained earlier. To decide on the right structure for your sale, from a tax point of view, we calculate the estimated tax bill from each option, as there's a considerable difference in the tax treatment. A share sale means you'll be taxed personally on the gain and pay capital gains tax. An asset sale would mean the company selling the business and paying corporation tax, and potentially you being subject to a further personal tax charge when you take out the profits. If you are considering a company share sale or personal asset sale, you may qualify for Business Asset Disposal Relief, or BADR, formerly known as Entrepreneurs Relief. BADR is a relief that can apply when someone sells part or all of their business and means you only need to pay tax at a rate of 10% on the gain if certain conditions are met. Each individual has a lifetime limit of £1 million worth of gains that can qualify, reduced from the previous lifetime limit of £10 million. In a share sale, the qualifying conditions are you need to hold at least 5% of the shares and voting rights, and be either an employee or officer of the company, which also must be a trading company. These conditions have to be met for at least 24 months before the disposal. So without BADR, if you were to sell your business for £1 million, you'd be liable to capital gains tax at a rate of 20%, which is £200,000. But if you qualified for BADR, this would be reduced to 10%, meaning you'd only need to pay £100,000, which is a huge saving. However, there are circumstances where you may not qualify for the relief, which we'll talk about later. If you are considering selling your pharmacy in the next few years, it's worth thinking about how you can improve the business's value before you sell. We recommend getting a professional valuation by pharmacy specialists and working with your accountant so you can identify the key performance indicators affecting the value and look at how these could be improved over time. Your accountant can also review your tax position to see if there are any other issues that might increase your bill, and work out the steps necessary to resolve them to ensure you get the best tax treatment when the time comes. Looking at this ahead of time gives you the opportunity to plan and map out a list of prioritized targets you want the business to achieve and a timeline over which you want to achieve them. This can be things like reducing stock holding and wastage, improving the gross profit margin, streamlining your staff costs, or making sure the sale will qualify for business asset disposal relief. The aim of this process is to increase the value of the pharmacy as much as possible before it's put on the market. It's important to remember every £100 spent on getting the right professional advice and input can increase the profitability of your business by thousands of pounds, which in turn can increase the value of your pharmacy by tens of thousands when it's time to sell. Now, as we've said, preparation is key, and it's worth looking in a bit more detail at some of the things that we commonly see in pharmacy share sales that can cause problems or present opportunities. I talked earlier about the conditions for BADR. If you have a company with more than one share class, this may need to be looked at, as some of the shares may not qualify for the relief at present. Your company also might not qualify if it owns too many investments or holds too much cash, as there is a risk that HMRC would no longer consider it to be just a trading company. As we said before, each individual has a lifetime limit of £1 million of gains that can qualify for the relief. So if you've ever sold or incorporated a business before, you may have benefited from the relief already and used up some of your allowance. Also, if your sale proceeds are over £1 million, they won't all be covered by the relief, and some could be taxed at 20%. However, all of the above can be dealt with if you have enough time. When it comes to business asset disposal relief, it's important to identify any problems as early as possible so you can take the necessary steps to remedy them. As well as affecting BADR, the level of cash in the company can have other implications to your sale which may need to be carefully considered. It's not unusual in pharmacy sales for us to see high levels of cash being retained by the company at the point of sale. For a seller, this can be desirable because it lowers their overall tax bill, but a buyer may not want to take over the company with such a large bank balance, as they'll effectively need to pay for the cash with more cash. In some cases, it can be possible to arrange for a cash extraction at completion, where the seller could effectively take out the excess cash, leaving the buyer with enough in their bank account for their working capital needs. Investment property owned by a company can also cause problems with BADR, but we more commonly see pharmacy companies that own the trading premises they operate from. Sometimes these are to be included in the business sale, but there are cases where the business owners want to take them out of the company before the sale so they can give the new owners a lease and benefit from the rental income. It's important to take tax advice on the most tax efficient way to do this. Another important area that's worth considering early on is what you want to take from the business in the form of salary, pensions, and dividends in the years leading up to your sale. Tax rates on salaries and dividends are generally much higher than the 10% rate you can achieve on sale with BADR. So it makes sense to take less salary and dividends from the business if these are going to be taxed at a higher rate. This will mean the company's cash balance will be higher at the point of sale, and care needs to be taken that it's not so much that HMRC will no longer consider the company to be a trading company and BADR won't be lost. However, it's also important to remember that some dividend income is taxed at 8.75%, which can represent a tax saving over the rate you're going to get on the sale. So it's well worth engaging in some tax planning in your final years of ownership to make sure you optimize your takings so that you're paying the lowest rate of tax overall on your lifetime earnings. These are some of the things to consider before a sale, but now let's talk about what happens once you've found a sale. Now, the team at Carter Bond set out the main aspects of the legal process earlier, and once your potential buyer pays the deposit, the next step would be the due diligence process and finalising the sale agreement. As accountants, our job is to work alongside your legal team to make this all run as smoothly as possible. The due diligence process gets underway and the buyer's accountants request a list of information. In a share sale, the buyers are likely to want to go back over several years so they can be as comfortable as possible about the history of the company. Your lawyers will go through the sale agreement with the buyer's lawyers to agree a finalised version. We'll also review this from a tax and accounting perspective, suggest any changes to the main terms and covenants, and carefully go through the warranties to make sure the buyers are made aware of any exceptional events or circumstances. You can see how important it is to engage accountants and solicitors who specialise in pharmacy sales to get this bit right, because pharmacy is all we deal with and we see so many sale agreements in the course of our work. We know what's appropriate and what's excessive to warrant, and so with our combined experience, we're able to limit your risk. In a share sale, the total amount you'll receive for selling your shares is made up of the agreed price for the goodwill and fixed assets of the business and an adjustment for the net asset position of the business at the point of sale. The net asset position is made up of the company's current assets. So that's things it owns or is owed, like cash, stock, NHS and VAT debtors, minus the liabilities, things it owes to suppliers or HMRC. If there are more assets than liabilities, an additional payment is made for the net asset value. But if the liabilities are more than the assets, a deduction needs to be made from the goodwill payment. When the buyers are happy with the results of the due diligence exercise and the sale agreement is close to being agreed by both parties, a target completion date is agreed for ownership of the pharmacy to transfer from the sellers to the buyers. It's generally helpful if the completion date can be at a month end, as this makes it much easier to calculate the position at the point where the business is to be transferred. Once the target date for completion has been agreed, we need to provide the buyer's side with an estimate for the company's net asset position at that date. Now, of course, we're unable to provide exact figures at this point, so we estimate this as best we can. This then gives the buyers an idea of the net current asset payment they'll need to make in addition to payments for the goodwill and fixed assets. Once completion accounts have been prepared and agreed by both parties, several months down the line, a final adjusting payment can be made for the actual amount due as per the accounts. When we review sale agreements, there are a number of things that we look at carefully. For example, the proposed method to calculate the net current asset figure, as this will affect your final payment. The agreement also sets out the terms by which the business must produce the completion accounts, and what the procedure would be if the accounts were not agreed by the buyer. We also go carefully through the tax warranties in the agreement and cross-check them with the company's accounts for the last few years to produce a list of any facts and circumstances that need to be disclosed to the buyer, and these can then be collated by your solicitors in the disclosure letter. The tax warranties are very detailed and refer to numerous statutes from tax and company law, so it's essential they're looked at by an experienced accountant familiar with your business and pharmacy sales. Putting the time in to get this exercise right means you can sign your sale agreement with peace of mind and confidence that your interests are protected. After completion, the next thing we need to consider is the completion accounts. These need to be prepared with extra care and attention to detail to make sure they're in line with the sale agreement and also represent the closing position as accurately as possible, so you can benefit from all the profits from your period of ownership of the business without paying for any of the business expenses from after this date. Once the accounts have been prepared on this basis, they're sent to the buyer's accountant, and under the terms of the sale agreement, they have a specified period in which to inform us of any disputes or to accept the account. After reviewing the accounts, the buyer's accountants will either accept them or send a list of any items they believe should be included or removed from the accounts. For example, payments made by the company after completion that they believe were incurred before completion. We would go through any points of dispute and try to agree them with the buyers and revise the accounts accordingly so that they are acceptable to both parties. The buyers will then release the final balancing payment for the net current assets, which means you've now received full payment for your business. The final step is declaring the sale on your personal tax return and calculating and paying the tax due. The sale will fall in a tax year ending 5th of April and would need to be reported in your tax return for that year. This would need to be submitted in the tax paid by the 31st of January the following year. As an example, if you sold your business on the 1st of January 2023, this would fall in the 2022-23 tax year, and your tax return and payment would be due to HMRC by the 31st of January 2024. If you received a total of £1 million for your business and its assets and paid professional fees of £50,000, your total gains from the sale would be £950,000, and the capital gains tax due on this after the application of your annual allowance would be just under £94,000. Once we calculate your tax bill, we can also advise you on ways you can reduce it. If you haven't already, you should take advice on estate planning and your will. It's also worth considering your exposure to inheritance tax at this point. When you own your business, you benefit from business relief, which means if you were to die, the business assets would be outside the scope of inheritance tax. But once the business is sold, business relief no longer applies, and your share of the cash proceeds would be liable to IHT if you were to pass away unexpectedly. We also advise all of our clients to talk to an independent financial advisor who can guide you on investments you can make for a tax-efficient income in retirement, so that all you're left to worry about is what to spend the rest of your money on. That's all from me. Thanks everyone for listening.
Finish on a high note there, Atif. I love it. A good problem to have.
Absolutely.
Yeah, so thank you so much, Atif, for that. And thank you to all our presenters, panelists tonight. We have quite a few questions. We finished in reasonable time. We've got at least 10 minutes. We've got a few questions to get through, perhaps more than we're going to get perhaps more than we're going to have time to answer, but let's just go straight to them and see how many we can get through. First of all, Paul, I've got a question here. I think you said you've seen it offline, but it was about the difference between selling with a lease or freehold.
Yes, yeah, we've had an inquiry coming in just from somebody with a limited company asking, is it better to sell with a lease or freehold? I think sort of generally speaking in the marketplace, buyers, if there's an option to buy the freehold and it's within their financial ability to do so, then that would be sort of the preferred option. I say generally speaking, it can depend on the value of the business being sold as against the value of the freehold being sold. So, for example, where it might not necessarily be so attractive is if you've got for example, a pharmacy with a turnover around 500,000, which might sort of generally sort of be attractive to first-time buyers, but it's occupying a freehold which, for argument's sake, is in an affluent area, might be worth £1 million. That kind of situation can make it a little bit possibly unviable for a sort of first-time buyer to get the funding to buy the whole the whole package, the freehold and the business together. So there are sort of variables to that. But yeah, certainly generally speaking, buyers do like, they do find it attractive, the freeholds available. I think if also it comes down to, as a seller, if you've got that within your means to decide, whether you want to sell the freehold or create lease. Another option to do is perhaps offer both options out onto the marketplace. So it kind of widens the options for buyers as well. So again, just makes it more saleable in the marketplace there. We sort of touched on obviously some of the issues that can be associated with leases where there are third-party landlords as well. Obviously, they can have a knock-on effect on sort of sale timescales for various reasons, and obviously Reena and Hammad went through some of the issues that can arise. That tends to be less so where perhaps as the seller of the business, you are owner of the freehold. You can obviously then create that lease perhaps hopefully a little bit more easily and more accommodating to assist the sale perhaps. So there's various factors that come into play, but yeah, generally speaking, from a broker's perspective, yes, if you can offer the freehold, then that is a good option. I don't know if, obviously there may be sort of some tax implications there. Also, if you sort of touched on properties and leases, I don't know if there's anything you want to add to that at all.
Oh, Atif, we've got you on mute.
Beg your pardon there, guys. Sorry about that. Yeah, it was really just to echo what Paul said. I mean, in terms of the tax, the tax would be different from the property, and it's just something that is worth looking at with your accountant as soon as possible to make sure you do understand it, so you understand what the true kind of what you're really going to get from the sale in terms of the pharmacy side and the property side.
Okay. Thank you. Hopefully that's covered that in thorough detail. So I've got one here that's come in probably for Carter Bond. What happens if the NHS contract is not in the name of the company, but we're selling the company?
Great question, and I'm going to nominate Hammad to answer that because we've had that on quite a few, and Hammad has expertly guided the seller through it.
Brilliant. Yeah. Okay.
So it started from Paul's presentation. If the FP34s have the wrong person's name on it, how do we know that? Sometimes the FP34s could have a personal name. That will make it very obvious. If it's not the company's name, then we know there needs to be a change. Other times it can be the name of the trading business. So if your pharmacy is called X Pharmacy and your company is called X Pharmacy Limited, it might not be clear. So the way to check is actually to go onto the NHS contract list, which is publicly available from the NHS's website. And there it will say what the contract name is, contractor name is, and what the trading name of the business is. So usually if it's the same, then you can assume. If it has the word limited in it, then you know that it's in the company's name. The other way to check is just to simply get in touch with the NHS to get them to confirm exactly what entity they have on their records. So sometimes we find that acting for sellers, they incorporated at some point in the past, but have actually been running the pharmacy for much longer. They may have never notified the NHS. The trading name would be the contractor name, and it's not clear to either the buyer, the seller, or even the NHS. They can usually go back through their records to find out if a change of ownership application was made. Sometimes if it's happened a long time ago, then the NHS just might not have an answer. They might ask for information like, can you prove that the company owns the rest of the pharmacy? So your employment contracts would still have the company's name on it. Your GPAC registration would still have the company's name on it. If you can collate enough evidence to show that the pharmacy is actually owned by the company, then the NHS could be persuaded that it's actually a clerical error. Worst case scenario, you may require a change of ownership application. And if that's the case, it's best to get started as soon as possible, because one of the reasons that sellers, other than for tax reasons, decide to sell a company is because it might be quicker than dealing with an asset sale with a change of ownership application from the buyer. But if you have to do the same thing in a company sale, then suddenly you've lost one of the key advantages, which is time. And so it's definitely something to get to the bottom of at the start. You should just ask your solicitor to say, can you check my name on the list? Can you check my FP34s? Does it look like it's in the company's name? Key indicator, the word limited should show up on the contractor name on your FP34s. And if that's not clear, then we can check the NHS contract list itself to say, which will confirm whether it's a trading name or the actual company name.
Great, thank you so much, Hammad. So we've got a few here. Atif, I know that offline you said there was one that you wanted to take, but I didn't know which one that was.
Yeah, I've got a question here from someone asking, concerned about the level of cash they've got in their business and asking, well, how much cash is too much cash when it comes to the relief? And if I have got too much cash, what can I do about it? So firstly, I guess it's a nice problem to have. We've got too much money. But obviously it does need to be dealt with, because we don't want that to mean we pay more tax. HMRC's rules on this are not cut and dry. It's a little bit of a grey area. They do give guidelines, so you need to look at those guidelines and see how they apply to your deal, and what, you know, to get an idea of what their view on it might be. But unfortunately, there isn't any way for us now to get advance assurance from them on how they are going to treat cash in a transaction. So it is something that needs to be approached carefully, and there is you need to make a judgment on how you proceed. If you do need to reduce the cash in the business, the most obvious ways to do that are salaries, dividends, or pensions. But obviously, as you'll know, with salaries and dividends, they have quite high tax implications. And if we're doing this to reduce tax, we don't want to be paying tax if we can help it. Pensions obviously lock away your money, although they're great from a kind of a future planning point of view, and do also give you a shelter against inheritance tax potentially in the future. So it's great to run up your pension, but obviously you are locking up that money for some time, and it's not the same as free cash. So it's not going to suit everybody. So again, there's no one size fits all. You need to look at the situation and see what you can do. If you are thinking of selling in a few years rather than immediately, and you have got a lot of cash there are other things you can do, like hive away that cash, or various kind of corporate mechanisms where you can separate the cash from the trading company and just sell the trading company. So there's lots of things you can do, but it just does need to be looked at as soon as possible.
Yeah, so there's a huge number of options there, Atif, and I imagine that if someone wants to start looking at that now, they could contact you directly and explain their circumstances, because it's going to need a bit of an expert eye on it.
Yeah, absolutely. I mean, we do find it's a fairly common scenario where operators have run their businesses for a number of years, probably not taken as much in terms of extracting profits over the years as they could have, and instead built up funds in the company. And then obviously, understandably, if they want to get that out of the minimum tax to enjoy potentially in their retirement. Yeah,
I mean, that's why you've probably done it for those years. Okay, thank you so much. Listen, we've got a couple of questions that may be quick that I think we could just squeeze in, unless there's anything that anyone else really wants to answer live. We'll pick up everything that we haven't managed to answer tonight, as I said, directly over email, with you following up over the next couple of days. So is there anything else that anyone really wants to pick up live?
Sam, very sort of quickly, I saw a question coming in about 100-hour pharmacies. Somebody mentioned that they were sort of planning to apply to reduce their hours down, and how much will add on to the goodwill value. First of all, I mean, every sale is individual, every valuation is individual. But bearing in mind, I guess we've certainly seen many sort of 100-hour pharmacies perhaps run or rely heavily on sort of locum pharmacies sort of to operate. So obviously by reducing those costs down alone, there can be sort of some significant savings, which, as I mentioned earlier, sort of add on to the bottom line. So not there's, as Artie said, not one size fits all, but I would sort of say anyone wanting to explore that, then contact us. We can we can do a free verbal valuation. We can have a conversation about it and give more sort of one-to-one advice, which would be sort of more perhaps a little bit more relevant.
Brilliant. Okay, thank you, Paul. I imagine the answer to the question, is it worth changing to a limited company to speed up the sale, Is that a one-word answer? Is there a yes/no answer to it, or is it circumstantial, circumstance dependent?
I think it's most likely to be a no. I think in most circumstances that would be something that would probably add delay.
Sure, yeah, it would net add delay. Okay, very useful. And how long does the process take? Is there a magic number that we can venture?
It depends. Sorry, I have to be a lawyer.
Yeah. Okay. I guess that's as good a place to any as any to call it for the evening. Thank you so much for everyone who's joined us, and almost everyone that's joined us is still with us right to the end. So thank you for that. We really hope you found it useful. Thank you to all our panelists who have given us such expert advice tonight. Thank you, Paul, Reena, Hammad, Atif, and from all of us, good night.
Good night. Thank you.